Hey, it's Mike Hambright with FlipNerd.com. Welcome back for another exciting VIP interview where I interview some of the most successful real estate investing experts and entrepreneurs in the industry to help you learn and grow. Today, I'm joined by Marco Santarelli, who's an investor, an author, and he's the founder of Norada Real Estate Investments, a national investment firm that offers turnkey investment properties. But today we're going to learn more about Marco, but we're going to talk about Marco's 10 rules for successful real estate investing. It's exciting stuff. Before we get started, though, let's take a moment to recognize our featured sponsors. RealtyMogul.com is an online marketplace for real estate investing, connecting borrowers and capital from accredited and institutional investors. Get a rehab loan fast and close in as little as 10 days. Rates start as low as 9%. We'd also like to thank National Real Estate Insurance Group, the nation's leading provider of insurance to the residential real estate investor market. From individual properties to large-scale investors, National Real Estate Insurance Group is ready to serve you. Please note, the views and opinions expressed by the individuals in this program do not necessarily reflect those of FlipNerd.com or any of its partners, advertisers, or affiliates. Please consult professionals before making any investment or tax decisions, as real estate investing can be risky. Hey, Marco, welcome to the show.
Hey, thanks, Mike. Great to be here.
Yeah. So I know you've been working on a lot of great stuff, and for those that maybe don't know you all that well yet, or maybe thought they did, but maybe they don't, tell us a little bit more about your background as to how you got and started in real estate investing. I know I read somewhere that you bought your first house at 18, so that's awesome. But tell us a little bit more about your background and how you ultimately got into real estate investing.
Sure. Well, it's always a question of how far back you want me to go.
Yeah.
But, I actually, at the age of 18, as soon as I could qualify for financing, I literally just jumped into it. And I bought my first property. It was a townhome. Needed work, so I bought the property. I gutted it, and then I brought my uncle in, who was a contractor. So between him and myself and a few other people, we renovated the property. I took applications from tenants. I rented it. I managed it myself and held on to it for a few years. So that whole thing was just done without reading a book or taking a course. It was just textbook. I knew other people were making, money in real estate, and they were creating wealth. And I thought, you know what, this is really where it's at. So I jumped in.
Hey, talk a little bit about your kind of inspiration, because when I was 18, I was bagging groceries, I think. So without, I guess I grew up watching This Old House and always had an interest in real estate investing, but it was not till much later in my life that it was a viable option from a kind of business or a career standpoint. So what kind of inspired you to get started at 18, where a lot of other people are thinking about a lot of things other than their career or building wealth?
Yeah, I think some people could say that they had parents that were real estate investors or were involved in real estate in some way. My parents both came from Italy. They were immigrants to Canada at the time. And so I never had a family, an entrepreneurial family, where they were investing in real estate or had their own businesses. My parents worked, and my grandparents actually lived with us, so I was raised by my grandparents, and they couldn't even speak English. So I just looked around at people that we had as friends, and they were kind of the millionaire next door. You would look at them and never know that they had fourplexes and all kinds of property and were very wealthy. But I just knew that they owned real estate, and I knew they were doing well. So I think I just knew from being an entrepreneur right from the age of 16, always wanting to start my own business, that real estate was where it's at, and it was probably one of the best investments at the time.
Yeah.
Later did I realize that it's historically the best investment that anybody could ever get into, and it's historically been the best investment in all of history.
Yeah.
So that's probably what made me jump into it.
Okay.
So from there, I ended up buying another property, and then I kept going, and I got my real estate license and started selling real estate to homeowners, and I just hated it. I didn't like being a chauffeur, carrying people around in my back seat, the back seat of my car, selling real estate.
Yeah.
But that's how it all started, just at the age of 18, jumping right in.
Yeah, no, that's definitely very interesting. I've said this several times before, so hopefully people on the show aren't getting tired of hearing this, but probably the single biggest regret that I hear that most real estate investors have is that they didn't start earlier.
Yes.
I think people realize everything you just said after they've been doing it for a while. and they're like, boy, I wish I had started this 10 years earlier, 15 years earlier. And so it's good that they ultimately get there, but what an opportunity to discover the power of real estate investing at the age of 18. That's awesome.
Yeah, but it's never too late to start, because with our company, we have clients that call us in their 40s, their 50s, and even in their 60s.
Yeah.
That are getting started in real estate, because you don't need to hit a home run on your first property. As long as you start building a portfolio and you have positive cash flow, you've got a good rate of return. You've got cash on cash return that is it's very competitive in the sense that you're fighting inflation. Real estate is one of the best, if not the best, hedges against inflation. So just the fact that you have a real estate portfolio and you're getting a better rate of return than what you can get in most other, if not all other investment classes,
right.
And it keeps up or beats inflation, you're ahead of the game already.
Right.
And equity will happen. It'll grow over time through that amortization of the loan. If you have appreciation, great. That's icing on the cake. So you're building wealth. So it's never too late to start. It's just great to have time on your side and be able to start in your 20s or 30s.
Sure. And so we're going to talk about your 10 rules for successful real estate investing here in just a minute. But tell us a little bit about Norada and the fact that you are a turnkey provider and you've effectively helped other people build wealth. And what's really intriguing to me is over the last few years, this is something you've obviously known for a long time, is that real estate is really becoming much more of an asset class that a lot of people can get into now that they couldn't in the past or didn't believe they could. So it's really becoming more of a Main Street type investment class that people can actually choose to invest in versus the stock market and other things. But just tell us a little bit about your company and what you're doing.
Sure. I started Norada Real Estate Investments about 10.5 years ago. Late 2003, I jumped back into real estate investing very heavily. In fact, my watermark was 84 units. And in that process, you might remember there were a lot of people pitching all these these seminars where they were selling these boot camps and workshops, and really they were to the tune of $10, $20, $30, $35,000 for these these workshops and boot camps. I don't know if they were worth anywhere near that. You could have bought a property for that kind of cash.
Those things are alive and well right now, my friend.
It's coming back. Everything's cyclical.
Yeah.
Absolutely. So, I was at a seminar, there was 1,500, 2,000 people, and I decided, I know enough about real estate, but you never know everything and you never stop learning. And I'm huge on education. Knowledge is very important. In fact, that's the first rule of my 10 rules of successful real estate investing is, educate yourself. But there were literally thousands of people buying into these courses. So I took these courses, these boot camps and workshops. And what I discovered in that process is that many people were spending tens of thousands of dollars trying to educate themselves on how to invest, but really weren't pulling the trigger. They weren't jumping in. They weren't making it happen. Many of them still didn't know what to do.
Yeah.
So this opportunity kind of fell on my lap. Investors were coming to me saying, hey, where are you finding these properties that you're buying? How are you doing your due diligence and analysis? How did you negotiate it? I mean, it was just one question after another. And I got to the point where I was realizing that people were really wanting to have someone hold their hand and provide them, an opportunity on a silver platter, saying, here's 70% of it. You do the other 30%, but essentially you're near the finish line. You could invest in your first, second, third property.
Yeah.
And that's really how the business kind of started. Yeah. So, but in a nutshell, to answer your question, sometimes I go off on a tangent. I apologize about that.
Hey, that's the story of my life, so I get it.
So effectively, we're a nationwide provider of turnkey investment property. The problem with the word turnkey is there's no industry definition of what that means. People have a general sense or an idea of what the word turnkey means, but no one really clearly defines that, and there's really no formal definition. And the way we define turnkey is this. It's pretty simple. A great market, good neighborhood, a good property that's either new construction or newly renovated, tenant in place, professional local property management. That is the core of it right there. There's a few other things that are built around that, but that is at the heart of what we define as a turnkey investment.
Yeah, and it takes some of the scary stuff out of the way for folks that want to invest. Yeah.
Right, yeah. And the whole thing about, and we can talk about this a little later if we have time, But the whole thing about choosing the right market and being in the right neighborhood with the right property maximizes your return and minimizes your risk. And if you do that right from the beginning, you'll eliminate a lot of problems going forward. Because a lot of investors make the mistake of being presented a property, and the property looks good, it has nice curb appeal, maybe it was renovated and the interior is in good shape, and the numbers are fantastic. And I don't mean to pick on certain markets. I mean, I do pick on Detroit from time to time, even though I've personally been there.
Everybody picks on Detroit.
I've been there about 25 times myself. I've bought a lot of property in Detroit in years past. Yeah. I've since sold it. But I know the market well enough that I can, say that I can pick on it. Although, Detroit's one of the fastest appreciating markets right now. It has been over the last 12 months. So from an appreciation perspective, it's been a good play. But in terms of the health and wellness of that market, economically, fundamentally moving forward, it has a lot of question marks because there's net negative migration, high unemployment. There's not a lot of good prospects going forward in terms of jobs. The city is effectively bankrupt, on and on and on. Anyway, again, I don't mean to pick on Detroit. My point is that a lot of investors are presented with these properties that look great on paper. They might have 15, 20% cap rates, which, in reality doesn't end up working out that way. But they get so mesmerized by those numbers and that property that they forget to look at the forest in spite of the trees. Let's look at the neighborhood. Let's look at what's going on. Let's look at that market. What is happening? What is it going to be like in 3 to 5 to 7 years from now?
Right.
So that's important.
And the fascinating thing, one of the fascinating things about those that are investing in turnkey type products is how easy it is to invest. I know a lot of California investors have been investing outside of California for a long time for obvious reasons if they're looking for cash flow. But gosh, it's easier than ever to own properties outside of your market, and just because of technology. I mean, you can effectively be there without being there, and the quality of property managers, seems to be going up and up. I know it's difficult to find good property managers, but I think more than ever, largely because of technology and word of mouth and things like that, property management has gotten easier to find, and certainly in major markets. So,
yeah, the internet has been one of the greatest tools in the last century for the free market and entrepreneurs. The amount of information at your fingertips that you can just pull up in an instant is unbelievable.
Yeah,
it's just revolutionized almost every industry.
Yeah,
and so the ability that for the average, typical middle class investor to be able to invest, not necessarily in their backyard, but in a market that makes sense, and be able to do the research to find those markets, is absolutely incredible. And then to be able to do your due diligence and narrow down, the properties that make the most sense, and be able to send contracts in on it, and select your property management company and your home inspector and your lender and all that kind of stuff. It's very powerful.
Yeah. We all need to be thankful to Al Gore, right?
Thank you, Al Gore.
I pick on Al Gore too much. You pick on Detroit, I pick on Al Gore. So, all right,
that's fine.
So let's get into your 10 rules for successful real estate investing, and let's go through those.
Sure. So the first rule is specifically, I've made the first rule, educate yourself, on purpose, because everything starts with knowledge and education. I like to say that knowledge is the new currency, and it really is. If you don't educate yourself, continually educate yourself, you're really doomed to fail, or doomed to follow someone else's plan. You don't know a good investment from a bad investment. You really can make better choices and accelerate your success and your wealth creation by educating yourself, reading books. There's a lot of great blogs on the internet. There's a lot of good podcasts. For example, your show is, in my opinion, one of the best. I listened to 2, and yours is one of them.
Thank you.
You're welcome. So there's a lot of information out there. In fact, it's to the point where, it's information overload. But the point is you really have to educate yourself, and knowledge is the new currency. And the more you learn, not only through reading and educating yourself just through material, but actually having the experience of having done it, buying your first or second property, your third or your 10th, and just keep going from that. So educate yourself is the first rule. Stop me anytime if you want. I'll just kind of roll through these.
No, yeah, absolutely.
All right. So after you educate yourself and you keep educating yourself. That's an ongoing process. The next thing is obvious. You've heard this time and time and time again, but it's really just to set investment goals. You know, a goal is different than a wish. So it's very important to actually write down. I kind of sound like Tony Robbins here now, you know, just in talking about this stuff. But a lot of people just skip over this step. They realize that they need a goal. They have a goal. Maybe it's subconscious. Maybe they just have it informally in their mind. But if you could lay out, you know, how many properties you want to accumulate in your portfolio over what period of time and what metrics those should have. Are you trying to achieve a certain cap rate or a certain amount of cash flow every month? You know, when do you want to retire? How much do you want to be earning from that portfolio? When you start writing it down, things start to become clear.
Yeah.
As a tangent, I'll just go off on a tangent here for a second. When we talk to our clients, you know, if they don't feed us this information, we start to ask probing questions. We want to know what their investment goals are. We don't need to know in great detail. We just want to get an idea.
Right.
But from there, you know, we can determine what their ideal strategy is. And it's usually all, you know, well, people who call us are always buy and hold investors. They're not typically flippers, but we can clarify their strategy based on their goals. And then from those goals, you can start laying out in bullet point form what their investment criteria is. Are there certain markets, certain property types, you know, certain number of bedrooms and bathrooms, price ranges, rent to value ratios, you know, a minimum amount of cash flow per door. So when you start defining those things, it's not that you can open up more opportunities. You start to eliminate possibilities and focus in on, like a laser, you know, the markets and properties that actually meet your criteria and fulfill those goals.
Yeah, from a goal from a goal planning standpoint, I am you know, I mentor a lot of folks, and I really harp on goal setting. And it's one because if you don't, it's really, I guess my purpose is that you don't know what to execute if you don't know what you're trying to achieve. And
right.
It's the same thing you just said, just differently. It's funny. I tell people from my corporate world, everybody always had analysis and plans, and we're going to do this. And I worked for a big a large retailer that everybody knows. And once it got laminated, then it like became the law of the land. So I tell everybody that. Same thing. You said publish it, print it, share it with your spouse, your partners, whoever, and laminate it or put it on the refrigerator or whatever, and think about it every day or all the time, because that's your roadmap for how you're going to get to where you want to go.
Yeah, I can't remember the statistic, but I read this a long time ago. But apparently, people who actually have written goals are 5 times or 10 times, like, it was an astronomical number, but much more likely to actually achieve or come close to achieving those goals than someone who never writes them down.
Yeah, yeah.
So I think there's a lot of weight.
Yeah,
you know,
and I think generally they're better looking people too.
Well, there you go. our host here. All right. So the third rule I have is to never speculate, and that's really important, because if you look back to 2003, 2004, 2005, people really weren't investing. Yeah. They thought they were. They think they were investing, but they really weren't investing. They were chasing after appreciation, and that was a mistake. Now, there were a lot of people who made a lot of money. They bought properties, wrote up the appreciation. In some markets, it was like 10 to 20%. I remember in Southwest Florida, there was a period of time where there was a 32% appreciation rate in 1 year.
Yeah.
But, you know, you should always invest with the long term in mind. Never speculate, you know, on the quick short-term gains and appreciation. Appreciation is great. It's nice to have. It comes in time. All real estate markets move in cycles. So if you pick the right market, you know, at the right time, you'll have the benefit of appreciation. But you never know when a market's going to peak. And usually you don't find out until 6 to maybe 9 months after the fact. Fortunately for most investors, real estate is a slow-moving asset class. So if you're smart enough to keep your finger on the pulse and you realize that the market has topped off, if you're maybe you could plan accordingly, sell the property. Hopefully the demand hasn't dried up or the financing hasn't dried up for it, so you can actually sell it.
Yeah.
But it's really tough to try and time real estate markets. It's doable. We can do it. You know, we track 401 markets in the U.S. MSAs, so we see what's going on, past, present, and future. But the average person can't do that, and so it's really a mistake, I think, to speculate in real estate, because I don't call that investing. That's not prudent.
Yeah. Yeah. Okay.
Which is a perfect segue, to the next rule, which is, invest for cash flow. There are rare exceptions to this, of course, but you always want to buy investment property with positive cash flow. I like to say that cash flow is the glue that keeps your investment together. Like I said before, you really want to invest and build a portfolio so you have passive monthly cash flow and you have wealth creation or wealth building in the process. You can't do that, or at least your runway is going to be really short if you can't keep that property because you're feeding it every month with, through negative cash flow.
Yeah.
So it's really important to have positive cash flow because it gives you a good rate of return, a cash-on-cash return to your invested dollar. But what you'll find is over time, you'll build equity through amortization and through appreciation. So always invest for cash flow. I think you would agree with me,
Absolutely.
But that's important. And I like to measure that in terms of cash-on-cash return and total rate of return. A lot of people kind of get hung up on the cap rate, which is fine. It's a very generic measure. It's more applicable to commercial real estate, but again, I like rules of thumb, and that's one rule of thumb I use just to quickly evaluate a property at a high level.
Yeah, great.
The next one is be market agnostic. This is a big one.
This is number 5, right?
This is number 5, be market agnostic. The U.S. is a very large country. It's made up of hundreds of local real estate markets, and that's the key word, is every real estate market is local. It has its own fundamentals, its own economics, its own housing market, its own supply and demand. They all operate independently of other markets. What's going on in San Diego is different than what's going on where you live in Dallas versus somewhere in the north like Detroit.
Right.
So they all move up and down independently of one another, and there are different demand drivers that are affecting those markets. So it's important to pick a market that makes sense. But the reason I say be market agnostic is still to this day, it amazes me, and even with the internet, being a powerful tool at your fingertips, how many investors still think or believe or are just religiously married to the idea that they have to buy something within a 30-minute radius of their home because they just need the ability to drive by it every once in a while and make sure it's there, or just be able to touch it and know that it hasn't disappeared or burnt to the ground. Right. I find that kind of humorous, but investors could do so much better and be more successful in their real estate investing business if they looked at other markets and realized that there are other markets, many other markets, that are doing better than their local market.
Right.
And here in coastal California, it's one of the cyclical markets, which you'll find very common around the coastal markets around the United States. I call some of these markets bubble markets because they go up and down like a yo-yo.
Yeah.
Property values here are very expensive. You're looking at $400,000 to $800,000 to buy a typical single-family detached home that doesn't rent for more than $2,500 to $3,500 a month.
Right.
So the rent-to-value ratio is very low.
And no chance of positive cash flow.
It's extremely difficult. Let's put it this way: you could create positive cash flow by putting 50 to 60% down.
Right.
But then the question is, and the argument to be made is, why don't you take that, that $200,000-$300,000 that you just used to put down that 50% on that property, and leverage that into 4, 5, 6 properties in, let's say, the Dallas-Fort Worth metro area,
right.
Have a better rate of return, better cash on cash, lower downside risk, because the risk is in the land value here. If the market, and I shouldn't say if, I should say when the market turns, you're going to see property values come down quickly. And it's not because of the commodities that are on the dirt, which is the bricks, sticks, copper,
right.
and all that good stuff. It's going to be the land value. So if you look at a market like Dallas or Houston or Indianapolis or Kansas City, many of the markets that we're in, the land cost is so low that it literally minimizes your downside risk because you can't go below zero on your land cost.
Right.
And you'll always have a replacement cost on your property. It is going to cost, $50, $60, $70 per square foot or more to replace that property if it burnt down to the ground. So by investing in these other markets, you're actually maximizing your returns, but also minimizing your downside risk.
Okay. Okay.
I don't know if that made sense or.
Yeah. No, it's important. You know, I actually, all of my rental properties are in my market here. So I'm guilty of what you said. And, but I operate my business here. I mean, I rehab and wholesale and do a bunch of other stuff, and I keep some as rentals. So that's primarily why they're here, because all of my rental properties I actually acquired myself. With all that said, I have not been into one of the rental properties that I've purchased over the last 5 or 6 years, ever, with the exception of when there's been a major fire, which I've had a couple times. I have one right now that we're rehabbing, and that was just because it was a long process. I don't manage them myself. If I'm in the vicinity of one of them, sometimes I'll think, let me drive past and see what it looks like. But then I'll think differently and say, no, I don't even want to know. I don't want to know if the grass is long or if they, you know, who knows. So I don't even want to know. But I think a lot of it comes down to comfort with the property manager, having somebody that I guess I feel more comfortable having the ability to go meet with and see my property manager more so than my houses. And with that said, you and I are thousands of miles apart right now, and we're having a discussion which it could just as easily be done with my property manager. But
yeah, well, you're really not guilty of anything if you stop and think about what I said, because you happen to be fortunate in that you are in a market, a great market that has strong fundamentals, a strong economy. Lots of demand. You have people moving into the city literally every day. Yeah. The last statistic I read, it went from 555 people a day moving into the state of Texas to 1,000, and I mean it was over 1,000 people per day are now moving into the state of Texas. Wow. And where are they moving to? Dallas, Houston, San Antonio, Austin. Yeah. So the demand for housing is always there. It's consistently there, or if not growing. Right. So you're in a market where the rent to value ratios make sense. You still find 8-9% cap rate properties. They rent up very quickly because you have a large rental pool. You have everything working for you. Right. So you don't have a need to diversify into another market unless you want to, which is actually one of my rules in terms of diversification. We'll get into that here in a minute. Okay. But you're in a good position, so you're really not guilty of anything. You're just fortunate to be in a good market that makes sense.
Yeah, yeah. But your point is, opportunities, markets fluctuate, and the opportunity window opens and closes, and to be agnostic to that and be able to move into markets where there's opportunity, just like you would in the stock market. When something is undervalued, you would go after it, and when it seems like it's a little bit overheated, you would pull back from that stock or that market per se. So yeah, I had lunch with a client yesterday. In fact, we're flying to Houston in 3 weeks. He's going to be picking up about four or five properties down there on a 1031 exchange, and we were talking about exactly that. We were actually using the stock market to be kind of an analogy to diversification in real estate, which might as well talk about it here. Diversification across markets is the way you diversify within this asset class. You talk to financial planners and stockbrokers, and they'll say, well, diversify. Well, the thing is, if you're diversifying within the same asset class, you're really not diversifying much at all. It's the same paper asset that's being traded on Wall Street. Right. But they use the term diversify a lot because you can't manage your risk in the stock market. You have no control. And so, they say, put some money here in this ETF and put some money over here in these blue chip stocks and put some money over here in these small cap stocks. Well, how do you do that in real estate? The way you do that in real estate is you could diversify into different property types within that asset class. But the better way to do it and the smart way to do it is to diversify across different markets, because when you do that, like I said before, every market has its own economics, its own fundamentals, its own supply and demand drivers. So when you diversify across different markets, you spread your quote unquote risk, in different areas. So if one market is maybe in a small down cycle 1 year, your property's in this other market may be appreciating and doing well, and people might be moving to that area now because there are new jobs because of the shale plays in oil and gas or whatever the case is. Right. But
But that's a prudent way to do it. And my rule of thumb, again, this is just me, it's my rule of thumb. I like to tell clients to accumulate 3 to 5 income properties per market. And once you've achieved that, if you still like that market and you want to continue, go ahead and do so. But if not, let's look at another market that's geographically different, that has enough distance where it's not affected by the other market, or it doesn't, share in the same economics.
Right.
And then build your portfolio there with 3 or 5 more properties, and then, keep moving on into other markets.
Yeah.
So
okay.
So that's the whole concept of diversification.
Yeah. Okay, so we're at rule number 6.
Yeah, I kind of jumped ahead of you here because being market agnostic, I jumped down to diversify across markets, which is number 7.
All right. Well, we could do whatever we want, my friend. We're making this up as we go along.
Yeah. So I'm just going to go back here, number 1 to number 6. Take a top-down approach, and we spoke about this just before the show here. Always start by selecting the best markets that align with your investment goals. A lot of investors, like I said before, they start by analyzing properties with little regard to its location. They get married to the curb appeal and the numbers on that property, which is effectively a pro forma when you first look at it. It's really not historically, in most cases, it's not historically proven numbers. It's not. A lot of times people are buying properties that don't have a tenant in there, so there's no rent roll, there's no proven history.
Right.
So they get attached to the pro forma numbers, and unfortunately, a lot of international investors that call us, will get mesmerized by a lot of markets in the Northeast and the Rust Belt, Detroit included, and they're really impressed by the rates of return, but they really don't put a lot of thought, if any, into what the economy is like and what the job market is like and all that kind of stuff.
Yeah.
So taking a top-down approach means don't start with the property, start with the market, then work your way down to looking at specific neighborhoods, the characteristics and demographics of those neighborhoods, and then looking at the properties. And this is actually one thing that we help our clients do. Once they've identified a market and we start looking at opportunities in that market, we start creating a short list of available turnkey properties that we have in that market, and we start sending them neighborhood profiles. And those profiles include detailed neighborhood characteristics, demographics. It could include appreciation rates, home ownership rates. There's just a slew of data that we could bury our clients with. We don't do that initially. We give them some, and we say, if you want more, we'll give you more.
Yeah.
But just because of the tools we use, we give them the tools, we give them the information to make prudent, logical, rational investment decisions on what they're looking at.
Yep. Okay.
So top-down approach.
Alrighty.
Okay, so now we're going to jump forward again to number 8.
Okay.
And this is something you talked about once or twice now, and it's using professional property management. I kind of jokingly say you live and die by your property manager. It is so important. I've seen investors suffer and have just terrible experiences in the past because they've had the wrong property management company who placed the wrong tenants.
Yeah.
And they just suffer for it because they have a lot of turnover. They're paying those turnover costs to refresh the property. They're paying that first month's leasing fee again.
Yep.
It's just a real problem.
Yep.
So
I've experienced that
important.
Firsthand, so I understand. And a lot of people have. Unfortunately, a lot of people have.
You're right, Mike. I think most investors have at some point in time a bad experience with a property management company and come to realize and learn what they should look for the next time around.
Right.
Picking and choosing the right property management company is very important because you want to know that they have good knowledge of the tenant-landlord laws, good marketing skills, strong people skills, the ability to deal with complaints and excuses, the ability to properly qualify and screen tenants. That placement is so important because it can determine how long that tenant will stay because they are a good quality tenant with good employment that can actually pay their rent. Are they a loafer? Do they have a criminal record?
Right.
I mean, there's just so many things to look at.
Yep.
So property management is extremely important.
Absolutely. Okay.
The next item is maintain control. And I touched upon this briefly before, but the nice thing about residential real estate is you can be a direct investor. You can actually own that property. You call the shots. You determine what is done, what is not done, who manages it, what type of tenant you want in that property, how much you spend on it. As opposed to investing in a fund or a partnership, and I'm not saying anything is wrong with a partnership, but as the old saying goes,
right.
The hardest thing about, or how's it, sorry, I I can't remember how the saying goes, and I don't want to butcher it, but it'll come to me in a minute. The hardest ship to sail is a partnership. That's how it goes.
Yeah. Okay. Yeah.
So, but there's nothing wrong with partnerships. I have partnerships. I've done partnerships, but the problem with a lot of paper-based assets is you really don't have control. You're a shareholder. You own a security. You own a piece of paper. You don't have direct involvement or control over the property.
Right.
And that's one thing I love about residential real estate is you determine what you're investing in and what happens with that property.
Absolutely. Yeah.
As opposed to leaving it up to corporations and fund managers like you do on Wall Street, where you never really visit the company that you're investing in.
Yeah, and it feels like I started off in investments. I was a finance undergrad, worked for a large bank, huge portfolio manager, and it just felt like I guess I was dismayed as soon as I started down that path. It just felt like it was mostly financial engineering. To make things, yeah. It wasn't most people that are investing. Gosh, I don't want to throw anyone under the bus here, but in my corporate world, I don't think most people were trying to get through quarter to quarter. There's really not a long-term vision. It's always about how do we prop the stock up as best we can for maybe out a year or two. But it was never, and not that those words were ever used, but you just kind of feel like that's what's happening is. Bonuses are tied to it, stock options are tied to it, things like that, and it just feels like there's not the same stewardship as there is with a actual physical asset.
Yeah, and I think part of what you're saying is the fiduciary responsibility of the investor that's putting up the capital to make that investment becomes secondary because companies are trying to achieve certain numbers. Stockbrokers, fund managers. I don't want to belittle, financial advisors, but right. A lot of them, are kind of honed in on the commissions, which in some cases can be very large, on these products. So, I understand what you're saying, and I'm not, like I said, I'm not a big fan of paper products.
Yeah.
Maintain control. Be a direct investor. It's the best thing you could do, and as you build your portfolio, you'll learn to love. What you've done.
Yep.
And then last but not necessarily least, the last or the 10th rule for successful real estate investing is something fairly unique to real estate, and that is your ability to leverage your investment. So I believe you should leverage your investment capital. It's one of the only investments, short of a margin account, with a stockbroker. But real estate is one of the few, if any, investments that you can borrow other people's money up to 80% to purchase and control income-producing property. That is phenomenal, and that's actually something fairly unique to the United States. It's not something that's common around the world.
Yeah.
We're maybe because the federal government has decided decades ago to subsidize housing, which you could argue was a mistake or a benefit. You could argue it both ways. Right, but the fact that we have governments, GSEs, government-sponsored entities that will allow you to borrow up to 80%, in the past up to 100%, but up to 80% of that purchase, and control investment property is powerful because it allows you to take a small amount of cash and purchase, real assets, real estate that produce income and create wealth for you over time. So take advantage of it, and really. Especially today with mortgage rates at or near historic lows, around 5% for a non-owner occupied loan, there's absolutely no reason that you can give me where you should just hold back and not stock up on as much of that mortgage capital as you can to buy as many properties as you can as soon as you can. So definitely leverage your investment capitals and leverage your investment capital, buy as much property as you can with financing. And the other thing too is just kind of a side note with mortgage financing, you've got inflation on your side. As much as we don't like inflation, the lender's debt, which is your mortgage, is fixed. It doesn't adjust every year to the rate of inflation, which I strongly believe is higher than what they report it to be.
Absolutely.
But that means every year you're paying that mortgage off in cheaper and cheaper dollars, because if our dollar is being devalued every year, which it has been for the last 98 years since the Federal Reserve came around, you have the advantage of actually paying that off in cheaper and cheaper dollars. And really, you're not even paying it off.
Right,
It's your tenant. Your
paying
tenant is
it off
actually
for you, right.
paying off your mortgage for you.
Yep.
So.
Yep. Awesome. Well, those are great. For those of you that maybe missed one of those or didn't write it down, or if you're driving in the car or whatever, we'll add these on the page down below, or a link to get Marco's 10 rules for successful real estate investing. And so Marco, tell us, for anybody that's interested in learning more about your company and the turnkey opportunities you have, where do they go for that?
Well, the best place to go, because we post a ton of information, is our website, which is noradarealestate.com. And Norada is Norada, noradarealestate.com. And there's a lot of good articles and tools on there that investors can use.
Okay. Well, Marco, that was a lot of great information you shared today. Definitely appreciate your time and appreciate you being on the show.
Thanks, Mike. It's been great. Appreciate the invite.
Yeah, we look forward to talking to you again soon.
Well, thank you.
All right,
Appreciate it.
Take care.
Take care.
Bye-bye. Are you a member of FlipNerd.com, the most robust real estate investing platform in existence, where you can find off-market wholesale deals and great vendors literally in your market? You can get access to advice from experts and learn about local clubs and events right in your backyard. If not, please visit FlipNerd.com and register for a free account. You can register in less than a minute. It's pretty much the coolest site that's ever existed in the real estate investing industry, so get on over to FlipNerd.com.